This narrated set of notes serves as an introduction to the highlights for Week 10, Part 1, topics focusing on analyzing a business plan. In Modules 9.1 and 9.2, the highlights include analyzing loan and investments and using interpolation and extrapolation for income and depreciation. The Module 9 scenario will have you analyze a business plan. Here are the Excel features you will explore in Sessions 9.1 and 9.2. Work with financial functions to analyze loans and investments, creating an amortization schedule, calculating a conditional sum. The 9.2 session objectives include performing calculations for an income statement, interpolation and extrapolation for series of values, and calculating a depreciation schedule. Before starting session 9.1, it is worth your time to review the visual summary for the session. Calculating the borrowing costs. Let's review the payment function. The payment function is used to determine the size of payments made periodically to either repay a loan or reach an investment goal. Here is Excel's formula, where the rate is the interest rate per period, N per is the total number of payment periods, PV is the present value of the loan or investment, FV is the future value of the loan or investment after all of the scheduled payments have been made. FV equal to 0 as an optional argument indicates that the loan will be fully repaid. The type is set to 0 when our payments are made at the end of the period, or set to 1 if the payment is made at the beginning of each period. When a loan will not be completely repaid, you can use the future value function to calculate the loan's future value. Here is the formula. Note that when using these formulas, the interest rate and payment period must use the same time unit. And the cash flow will indicate the direction of money to and from an individual or a business account. So positive cash flow represents money that is coming to the individual or business. Negative cash flow represents money that is being spent or leaving the individual or business. If the loan is totally repaid, then the future value will be 0. Here is a sample worksheet from Session 9.1 that you will use to analyze the future value of a loan. Note that you can also use the FV function to calculate inflation. This is explained in the Insight section on page 536 of your text. Looking at this example sheet, we see that the present value is positive cash flow because this is money we are borrowing and being loaned to us. The quarterly payment is negative cash flow because this is the amount we are paying out for the loan each quarter. Creating an amortization schedule. An amortization schedule specifies how much of each loan payment is devoted toward interest and toward repaying the principal. This is the amount of loan that is still unpaid. To calculate the amount of a loan payment devoted to interest and to principal, use the IPMT and the PPMT functions. The IPMT function returns the amount of a particular payment that is used to pay the interest on the loan. Here is the function, the arguments you will need. The per argument defines the period for which you want to calculate the interest due. So we could use this to generate all of the individual payments over the lifetime of the loan. For the principal amount, we use the PPMT function in Excel. Notice that the argument list is the same. Here is a chart that shows the relationship between principal and interest over the lifetime of an amortized loan. It also shows why it is wise to pay extra on the principal, especially in the early time frame of the loan. In Module 9.1, you will also examine calculating the cumulative interest and principal payments for the amortized loan. Review the Session 9.2 visual overview on income statement and depreciation before starting this section. When we want to project future income and expenses, a key business report is the income statement, also known as a profit and loss statement. This shows a business's income and expenses over a specified period of time. Most income statements are divided into three main sections. 1. The income section. This section projects the income from sales as well as the cost of supplying those items. 2. Expenses. This section projects the general expenses incurred from operations. And 3. The earnings. This section estimates the net profit and tax liability for the business. Income statements are usually created monthly, semi-annually, and annually. Here we see the income and expenses sections of the profits and loss statement. Projecting future income and expenses. You will explore linear and growth trends. For a linear trend, the values change by a constant amount, and when charted, this appears as a straight line. A growth trend, the values change by a constant percentage, and so this appears as a curve. The greatest increases occur near the end of the series. This is an important aspect of a business plan's income statement. We need to be able to project future income and expenses. One method of projecting future income and expenses is interpolation. If you know the beginning and ending values in a series and whether they constitute a linear or growth trend, we can autofill the missing values. Calculating the cost of sales is another part of the income statement, also known as the cost of goods sold. And the gross profit is the difference between sales revenue and cost of goods sold. Another way to project future income and expenses is to use extrapolation. Extrapolating from a series of values differs from interpolation in that only a starting value is provided. Succeeding values are estimated by assuming that values follow a trend. Excel can extrapolate a data series based on either a linear trend or a growth trend. Remember that with a linear trend, values are assumed to change by a constant amount. With a growth trend, values are assumed to change by a constant percentage. Calculating depreciation of assets. Tangible assets are a company's non-cash assets such as equipment, land, buildings, and vehicles. Tangible assets wear down over time and lose their value. The loss of the asset's original value doesn't usually happen all at once, but it is spread out over several years. This process is known as depreciation. To calculate the depreciation of an asset, you need to know the following: the asset's original cost, the length of the asset's useful life, the asset's salvage value, this is the value at the end of its useful life, and the rate at which the asset is depreciated over time. There are two ways to depreciate an asset: straight line depreciation or declining balance depreciation. You will explore both in the lab. This chart shows straight line versus declining balance depreciation. With straight line depreciation, the asset loses value by equal amounts each year until it reaches the salvage value at the end of its useful life, where the cost is the initial cost or value of the asset, salvage is the salvage value of the asset at the end of its useful life, and life is the number of periods over which the asset will be depreciated. Declining balance depreciation. Under declining balance depreciation, the asset depreciates by a constant percentage each year. Depreciation value is highest early in its lifetime. As the asset loses value, depreciation amounts steadily decrease, though the percentage decrease remains the same. This is an example of a negative growth trend. As we see here, the asset depreciates more quickly initially under declining balance model than a straight line mode. So you can think of buying a new car. It depreciates in value very quickly once you drive it off the lot. Adding depreciation, taxes, and interest expenses to an income statement. These are all part of a company's income statement. Depreciation is part of a company's income statement because even though the company is not losing actual revenue, it is losing worth as its tangible assets decline in value, and that reduces its tax liability. This is the end of modules 9.1 and 9.2 Introduction. If you have any questions or wish to discuss any of these features, post to the class forum.